Just doing an audio check. Can't seem to find my own stream. There it is. There it is. All right, I just heard myself. So my audio is working. So good morning, folks. Good morning. And if you don't already know, Pal will be testifying here in a few minutes. Just want to put my risk disclaimer up real quick. All right, so obviously I've had the flu last week and my voice has been not cooperating. Yesterday I did a lot more talking than I should have, so I'm going to try not to do that. Today I'm going to talk just about what is salient at the moment. So the economic calendar for today and tomorrow shows that we have Fed Chairman Powell testifying at 10 o'clock both days, today and on Wednesday, which, in my opinion, you should not be trying to speculate this morning. No one has any idea. I don't have an idea that is high probability, that is low risk. When the Fed is involved, all things go out the window, my concepts included. Okay, because it's manual intervention. That means they're going to do whatever they're going to do, period. It is not a lack of liquidity, as sometimes people will say. It is absolutely controlled demolition. Okay, so because of that, I tell my students, and if you're listening, you're a student, whether you like it or not, and that is a time when you want to sit on your hands and do nothing. Be content with not knowing and give yourself permission. I don't know what they're going to do this morning. I have no bias. I hold no bias. You shouldn't have a bias this morning either. What you're doing is looking to see how the testimony that the Fed chairman gives during the 10 o'clock hour and what they leave in the wake of that, meaning what the market leaves in terms of liquidity and what the market leaves in terms of inefficiency, because they're the only two factors that the market is considering. It's either going to go up for buy stops or reprice to an inefficiency like a fair value gap that will be above price, or it's going to go down below an old low or lows for sell side liquidity, or go lower to an inefficiency like a fair value gap below market price. So what you're doing is you're going to be observing this morning the effects of what the Fed chairman can do. He's not pushing price around. That's not what's actually happening here. And again, it's not a lack of liquidity because he's talking. The market is just going through a series of manual interventions where they're going to run to levels that may or may not be expected by you. And every time that I've ever done this, trading during these periods, I've never felt comfortable. Even if I was right, I did not feel comfortable. Whereas any other time, I'm not influenced by whatever the market's doing. I'm not scared of it. I'm not afraid. I'm not clueless, lost in the charts. I know what I'm looking for. But because there's manual intervention when Fed is involved, that means everything and all the rules go out the window for that period of time. Once that testimony is done, a couple minutes, maybe 15 minutes after that, the lay of the land, whatever the chart shows after that, that's what I utilize for the PM session. So speculation in the morning session really is just a gamble. And if you win, it would be foolish for you to attribute that as skill, and some do, and to speculate during this time period and willingly open yourself up to risk when you have no idea what it's going to do. You have no idea where they're going to take it. You have no idea how they're going to do it. I don't know what profile they would be using today. It means like a schematic or a roadmap, what they would run for, which is how I use narrative. Like when I look at price action, I'm outlining things to you like yesterday. The idea of how markets book, where they go, why they go this level first, then that level second, that's all narrative. And I don't have a way of knowing the influence when the Fed steps in. So to respect that risk and also to communicate that to you as a student, it's important for you to know that you should not think that you should know what to do this morning. To do so, to believe that, is foolish. You're literally gambling. That's the definition of gambling, because you don't know what the market's going to do this morning. Whereas any other time, I have a pretty good inclination about where markets are going to go. And I think I've proven it so far for a number of years now. But there's no weakness in saying that I don't know it right now, because it's the truth and no one else does either. So you can watch other people out there gamble, whether they're in live streams or come back after the fact and show you, this is what my system, this is what I did as a trader. Call it live. If you're not doing it live, it didn't happen. And I don't have any shame in telling you that as your mentor, this is a time when I don't know. And I don't know. There's no secret I'm holding back. There's no, method or model that works perfectly in times like this. I don't have that. So I simply step aside and let the market do whatever it's going to do and let the carnage unfold. And as I like to tell my long-term students, let the gamblers sacrifice themselves on the altar of chance. It's the same thing that goes on when it's the non-farm payroll, which is this week too. So you're looking at a very, very difficult terrain as a trader this week. So I'm just going to let this mark some time until we get into 10 o'clock. I'm going to try not to do too much talking today. I'm going to be observing anything that's noteworthy. I'll talk about anything that is not noteworthy to me. I won't mention. Okay. So it's more or less for you to observe real time with me and what I find is useful, what's informative rather, that I may reflect on in the PM session. The PM session is 1:30 to 4 o'clock, New York local time. So I'm not interested in pushing any buttons this morning. Neither should you. So that way we know what we're doing. The foolish thing for you to do is to say, well, since I wouldn't be trading, I'm not going to pay attention and watch price action. That would be foolish of you, because it's important for you to understand how the market behaves when the Fed steps in. So when it's pertinent, I'll mention certain things. If it's not, I'll remain quiet. So far this morning, the dollar index has moved up into a buy side liquidity pool. If you look at your high of yesterday on DXY, the high comes in at 104.691. We've already swept that this morning. I'll pull that up for you here. Okay, so we've taken out yesterday's high. NASDAQ has swept its relative equal lows. here. Okay, so we've had that. Now, for the purposes of study, what I do when I'm looking at the market like this, and I'm not pushing a button this morning, okay, I'm not going to come back and like on Twitter and say, you want to see a dose? It's usually when I speculate on the things I've shared publicly in advance, not just pulling something out of thin air. The exercise I go through when I'm looking at like non-farm payroll, if I'm watching non-farm payroll numbers on the Friday, like we'll have one this coming Friday, or if I'm looking at FOMC and the rate announcement type of thing, or if there's a testimony like this with the Fed chair, what I like to do is I like to annotate where I think if I were in complete control of the marketplace, where would I personally steer price to and why? So what that means is I annotate the 5 and 15-minute chart buy side liquidity pools. In other words, the highs that haven't been returned to in the 15-minute time frame. That would look like this. I know we're looking at NASDAQ, but it's the same thing for ES as well. So I would have this high here annotated here. And these are still relatively the same. So there's sell side below here, but if they're going to go below that, it wouldn't be too much to expect for it to reach below there. So in this case, since it's so close in proximity to that low, these lows here, this one and that one, I would annotate that. This thing always fights me. And the high here. So those two levels I would be watching to see which one of those levels does the Fed influence first. So if it goes here, then I would study to see if it goes from here to that. Or if it goes to here first, then look for that one there. It's not a matter of being right or wrong. It's not a matter of a trade setup. It's just I like to do that as a personal exercise in an observation. So that way you're not just looking at the chart blindly, not knowing what you're paying attention to or what's relevant to you. It just helps, with reading the tape. Reading the tape is not pushing a button, not demo trading, just observing price, getting a feel for what it's doing right then and there, and its experience. Chart time is basically what it is. Now, because we've approached this low here and didn't take it, and at 10 o'clock, I would, if I were running things, I would take it up here first and then come down here and maybe even as far as down into this fair value gap over here. It does not mean that's what's going to happen, so please don't read into that and don't come back later on and say, oh, he got it wrong. I'm just telling you what I'm watching on a day I wouldn't be trading anyway. All right, so it's 10 o'clock. Let's go to ES now. So we are in this new week opening gap here for this particular week we're trading in now. And the next downside would be here. If we get to the midpoint between both, it would be reasonable to expect it to reprice down to here. Dollar index is expanding higher. So risk off is the flavor of the morning this morning. Pound dollar, for those that are in Forex, is really taking a dive from 1.1985. We're in the 43s, 42s now, off of a fair value gap. You can find that fair value gap on your 5-minute chart for pound dollar at the 850 candle on the 5-minute chart. Dollar index, next pool of liquidity on buy side would be on the 10 a.m. from Friday of last week. and that high comes in at 105 even. We're in striking distance of that now. So we've breached the midpoint between one new week opening gap to this one here. So your expectation should be repricing to here. It's a 15-minute chart, so let's go down to a 5. Look how the bodies are respecting that new week opening gap. See a lot of folks saying, I'm rebranding something, gaps and such. No, I'm teaching you how to use them for real, not just, oh, there's a gap there. It might go there. I'm telling you how to use them. And once they go there, I'm not done with them where everybody else is. That's the difference. That's the context. And that's why it's still trending on Twitter. If it's something that's always been around, the people that have used it before wouldn't show the excitement they've now garnered with it. You never heard anybody talk about using a weekly gap as a means of mapping out where the market's going to go to the next one too. But that's okay. I understand. Inferiority complexes creep into this industry a lot. So far we had about 20 handles or so on the downside right at 10 o'clock. It's important not to look at these types of moves and think that, oh, I wish I would have. This is a way of forging patience and self-control. Moves like this happen a lot without the requirement of the Fed being a factor in it. When you introduce the Fed, you introduce uncertainty. You don't know which side's going to happen first. And to be wrong, on a day like this, it can move against you quickly. And a lot of you that are new are afraid to use stop losses. Unfortunately, it's not something you should be doing. You end up hurting yourself by not understanding the risks involved in a day like today. I just noticed every time I run the highest latency or lowest latency on YouTube, you hear how this thing is screaming? Like it's the fans really running to keep it cooled down. It didn't do that before. I didn't notice yesterday I had headphones on. And you don't have to whisper if I'm talking to you. All right, so dollar index is now running to, it's already gone through its 105 buy side. So the next buy side liquidity pool for dollar, still showing risk off, would be the high on March 2nd, Thursday. The high being 105.18. It's about to pierce through that now. Let's look at the dollar real quick. Okay, so that's our old levels here. Let me take these off because that's not pertinent to anything we're talking about right now. 105 is cleaned out. Next level of interest we've had on dollar was a 105.34.1. And then 105.631. So if my memory serves me correct, this is the old high, consequent encroachment, and then the rejection block on the daily chart. Okay. That's the 1 minute chart. You can see that you don't really have any opportunity. Once it starts moving, it's over. Anything in here shorting would be chasing it. I would require at least one up close candle to get in sync with it if it was something like on a day that I expected a low resistance liquidity run. But because there's no retracement, you just got to let it go. And again, I'm only comparing and contrasting that with what another day would be, opposed to like what we're seeing the Fed having an influence today. If it wasn't that, if it was another day where the Fed chairman wasn't jawboning in this movement here, I would be trying to get short, but I would require an up close candle to do so. And there's your difference between a weak open gap that everybody knows about in trading, yes, but you don't ever hear anybody talk about what I've been teaching you, which is taking them and stringing them together for a narrative. So moving from one new week opening gap to a previous new week opening gap. And this has been traded to and through multiple times, but it's acting like a magnet because it's algorithmic. The market's going to reprice the gap for the purposes of fair value. It has nothing to do with buying and selling pressure. If you can accelerate to the downside, we have one down here, but it doesn't need to go all the way down to that. Between both of them, midpoint, that's my event horizon. We watch to see does it have a willingness to get down to at least the midpoint of it. Dollar index has cleared its not yet. Hasn't done yet. Yes, it has. It just has cleared still. Let's go with the dollar real quick. Okay, so it's traded back above. And let's go into a daily chart. It's the rejection block here. That's what that dotted line is. And the next line was going to be the consequent encroachment of the wick. This one here. And everything resumes back to, this is halfway of this wick, which is consequent encroachment, and this is the old high. And this is where I've mentioned that I feel that the dollar could be trying to get back up into, which is the volume imbalance on the daily chart. So it looks like that. So we had this really drawn out consolidation, which is frustrating, but we're looking for it to get up into longer term here, which will mean bearishness on equities and on foreign currencies. When's the last time you heard someone talk about a Sunday gap being referred to after it's been used multiple times and weeks ago? You don't see that, folks. Sorry. Not to hurt anybody's feelings, but that's just the reality of it all. It's not rehashed, it's not revamped, it's not anything except for the real logic behind what makes these markets bulk price. If that hurts your feelings or upsets you, you're going to have to grow through that. Okay, 10 minutes after 10. So we're at that crossroads right now where dollar has reached into a buy side liquidity pool, back into its rejection block in the daily chart. it's done so in a straight shot, one run, straight up, one direction, and we have pierced and traded through the lower close proximity new week opening gap here. So this is the one we've been working for this week. Now we're here. And yes, I have a teaching that I'll be producing for this week on YouTube with the new week opening gap. So we have some rules to work with. Just want to pull up pound dollars. I know a lot of you guys are Forex traders. Let's pull it on the 5-minute chart. There's the fair value gap there. I mentioned earlier. And the bullishness on the dollar. I really took a dive. Go back to NQ. Let's take a look at Dow. I don't trade Dow. I like to use the Dow as a barometer. Much like I use the dollar index with every other market. When I'm looking at the indices, NASDAQ or ES, I'm referring to Dow for the purposes of SMT. Comparing highs and lows together. Watch these lows here. I'm sorry, watch these highs here comparably as I go through ES and NASDAQ. See how flat that is comparatively? And look at NASDAQ. There's respective highs. And then again Dow. And again ES. See the divergence there? And you see the weakness. So from one new week opening gap to another new week opening gap, price has been delivered algorithmically, yes, but with a manual intervention. So they push it real quick, sudden, one direction. And my question to you is you're saying that the market ran out of liquidity and just happened to go randomly down into an old Sunday gap opening? Is that what you're saying? That's your argument? That's what we're going to believe? It makes no sense. Okay, it's controlled. Everything's controlled. Even when they're intervening manually, they're taking it to levels that I'm going to teach you exists. But the problem is I don't know which one they're going to go to because they're intervening manually. And because I don't know with a great deal of probability how to anticipate what they're going to do, because many times whatever the Fed chairman would say, even if the rate announcement is in line or not in line with what everyone expects, because you see like in calendars and fundamental websites, they'll say if the Fed is hawkish or dovish, this would cause this to happen in the marketplace. And then when it comes out and it comes to either expectation or misses the expectation, in other words, whatever they think is going to happen with rates, and then the opposite actually unfolds, well, then they'll say, well, that's because it was priced in weeks ago. But they didn't say that before that. So they're looking for an excuse to justify something that's already happened. I'm looking for a signature to justify why I think price is going to go somewhere. And I'm usually right on days that are not having influence like this. And that's where I try to focus. I try to teach my students to focus there. That way, the probabilities are in your favor, at least in my favor, as the analyst. And if the analyst isn't correct, the trader that's using the analysis isn't going to be accurate either. So it goes back to knowing what you're looking for, when you're looking for it, and does that environment that you're trying to speculate in or observing, is it conducive for high probability in the first place? And whenever you have the Fed, talking, speaking, testifying, it's equivalent to a rate announcement where you don't know the effects of the marketplace. You can all have, oh, they're going to cut rates, or they're not going to cut rates or increase rates. Everybody has an opinion, but that opinion means nothing. It has no bearing on what markets are going to do, period. They're going to book the way they want them to book. And it matters not how many people are buying and selling. Go into a 1 minute chart. Dollar index making a higher high here. So we would want to see that low taken out on ES. That hasn't happened yet, but dollar has made a higher high. So if this doesn't make the lower low, we might be seeing a short-term low forming and need to trade up a little bit. Okay, dollar's coming off its highs, and ES is making an attempt to reach into a little bit deeper in this gap right here. Okay, so there's buy side here and an imbalance there. And what I'm actually looking at, I'm looking at the dollar index on a 5-minute chart, and then scrolling to a 15-minute chart and an hourly chart, and I'm monitoring, does it continuously provide feedback that it wants to keep going higher? So far, it hasn't made a higher high than the high it's already produced, which is problematic for ES continuing, at least near term, on the downside. So we're just watching to see what we get in terms of delivery on ES. Also, if you look at the Dow Jones, Dow Futures YMH2023, it's made a lower low where ES has not done so either. So whenever we're looking at that, it gives reason to be concerned about either consolidation or a potential short-term reversal. Many times when I'm like, say this is a day where it wasn't the Fed and I was short already. Whenever I see situations like this, like the Dow making the lower low, NASDAQ failing to make the lower low, and ES not making the lower low either, to me, I would want to take more of the position off because it could create a retracement higher against the position I would have open. So these are all things that I weigh in the balance as price is delivering. Dollar index still hasn't had its higher high since it's formed it. So far, the high on today is 105.265. I would want to see a continuing rather higher in the dollar to get to 105.341 and in a lower level ES, and that would bring things back to being symmetrical. So it means everything being equal, higher high in dollar, lower lows in all index futures, whether it be ES, NASDAQ, and Dow. Watch how price is utilizing this old new week opening gap. If you're new, how do you know you're new? You look at this move on the chart and you think, I wish I could have got some of that. That's infancy. As someone that's not been around long enough to know that things repeat. All right, dollar indexes just dipping below that 105.181 level. If dollar slips lower, okay, so in other words, say the dollar starts to come back down into its rally up and trades into like 104.90, something like that, I would be watching to see this fair value gap become support and maybe run up into this area here. So it would be like this. And it's not a trade. It's just something to observe. This is what I do on days like this. I'm not pushing a button, not even in a demo. So I'd be watching for it to draw up into this area here, preferably coming back down in and touching the fair value gap here as support. Dollar slipping in here. Now, it was real time that I walked you through the idea of those lows not being confirmed. Okay, so remember I was telling you about if I was in a trade, I'd have most of my position off. And this is generally where I would be getting stopped out. My stop would be above this high here, trailed lower if it was a day, not because we're in Fed, I'm not trading. But if it were any other day and I was short, my stop would have been trailed here because of that reluctance of seeing lower lows in ES and NASDAQ while the Dow did make the lower low. And if you missed it, just watch the recording and go back and you'll see me explain that and show you the charts. If it runs to this area here without returning to this, that would be a day, or that would be a trade that I would miss if it was any other day, because I would absolutely, if it wasn't Fed today, if it would have came down to this level here, I would have said, now watch this as a potential long to here. I wouldn't do it today, but if it was any other day, I would be taking that trade. It'd be a 10 handle run. Now we have a buy side imbalance, sell side inefficiency, meaning from this candle's high and this candle's low, the one candle in the middle, all that big movement here, you're looking at this high, that low. Midpoint between these two reference points is consequent encroachment because it's an inefficiency or gap. If it was an order block, it would be mean threshold. But this is consequent encroachment, 4.024 1/4. Okay, so that's consequent encroachment. Now we have two things here as a discount. This one here is the first one. The second one is this fair value gap. I mentioned that if it returned back to it without touching this area here, on another day, not today, I would utilize that as a long to get up to here for about a 10 handle run. We've done repriced all the way through this buy sign and bell, sell sign inefficiency, and we're in the fair value gap. So watch and see if it delivers from here up to here. If you have the benefit of toggling between Dixie or DXY, do that on your 1 minute chart. You would want to see dollar index not rally. It can stay consolidated, or preferably go lower into its buy side and bell, sell sign efficiency on its 5 minute chart candle at 10 a.m. Watch this wick. We wouldn't want to see it trade below midpoint of that consequent encroachment. It can touch the fair value gap now, but I'd rather see it not do that because it's already done it. Okay, back into that buy side and balance, sell sign efficiency is low and fair value gap. The risk would be on this candle's low. See where the bodies are forming? The wicks can do the damage. They can trade outside the lines. The bodies of the candles, that's what I'm monitoring. I'm watching all that. Okay, dollar index has a fair value gap at the 1 minute 1021 candle. That's like the last line of defense for me because it's inside the breaker for dollar. If you look at the down close candle on 1 minute DXY, that candle being at 1012. So we can trade up into the fair value gap that's at the 1021 1 minute candle on Dixie, and inside that bearish breaker, which would be 1012's 1 minute candle. It's inside that now. So far it's giving nice feedback. see it here. There's the gap, and there's the breaker. So you can see it real time. And that's 5 handles so far. So you want to screenshot that, and it hasn't even taken out the short-term high yet either. A little bit of a struggling point for dollar here. The candle's not closed yet. I'm just getting it there so I can adjust it when it does close. Oh, there it is. It's good. So my eyes on that fair value gap and bearish breaker on the dollar index on its 1 minute chart I just showed you. As long as we don't vault above that, we should have no problem. There you go. So there's the outline of a real-time trade idea. Did you need to see a button being pushed? No. But the logic is there, and if it's not there, I would fail. You wouldn't be seeing me calling it, outlining it, and delivering again. I have this consequent, it's not really a consequent encroachment, but it's the level of fib projection off of this here. And also if you measure the consequent encroachment of that CIBI, nobody's excited, nobody's surprised. You hear any animation in my voice? No. The old hat stuff. Same stuff over the last 3 decades. So consequent encroachment of the CIBI would be this level here, but from this low to that high, and dollars really has really slipped lower as we were expecting it to do. So that's probably random. So there's the breaker line we talked about. And then inside that breaker, we have the fair value gap I was mentioning. Perfectly. And I'm going to do that with this color here. So that's the anatomy of intermarket relationships and how we look at one thing versus the other. We cleared an important level that I mentioned before, which is the rejection block on the daily chart. That's what this dashed line is. Go back and look at old recordings, and you'll see that I've been talking about that. That's not just because today, because the daily chart PD array is important. You'll refer to it again. This down close candle between the high here and this high here. Remember, this is point 1, swing high 1, swing high 2. Between swing high 1 and 2, the low, in between, that's the bearish breaker. It's a breaker because we went below it here and have taken buy side. Then the market comes back up, trades into what? An imbalance inside of a breaker. Lower dollar means what? Risk on. Risk on means what for ES? Higher. Just random higher? No. We have to get a measurement. My eye was looking at this high to that low, midpoint in that area. First imbalance was here. There's no fair value gaps in here. So I took your attention here, and then if we got overzealous on the upside, and because of the breaker on dollar, that means using swing projections, from the fib anchor to that low to that high takes us up to this level here. It may not get there. I don't care if it does. I'm not going to make anything. I'm not going to lose anything. But I'm showing you the logic. If this was a day where the Fed wasn't impacting price action, if they're not intervening, then I would be in there doing that trade that you watched me outline here. Trading what? The returns of the fair value gap here. My stop would be down there. So there you go. You would want to be taking partials here because you're inside the lower bracket of between this candle's high and the fib projection and the consequent encroachment. So you're encroaching on a real premium in the marketplace. So you want to distribute your long positions at times when the market is at premium. We don't need an overbought indicator to indicate whether we're overbought or oversold. We're looking at the range in itself. Does that make sense to you, son?
Yes, sir.
You see how it reacted down here? It went twice, but look at the body staying inside between these two blue. Let me make these lines a little bit thicker. So in between those two heavy blue lines, the bodies are telling you the narrative that it's going to respect this imbalance and then reprice to a premium. What's the premium? Near term, it's this high. Then it's the imbalance here, which is a SIPI in the form of a fair value gap. Sell sign imbalance, buy sign efficiency between this candle's low, that candle's high. That little movement on that one candle, that's what I highlighted. So it went back up into that. And then we have this area in here between this midpoint of that candle's high, I'm sorry, that candle's low and that candle's high. That's what that measurement is. It's half of it. But the projection from this low up to this high just with the fib, I'm trying to build a confluence of levels to justify how far this retracement can go. When really, on a day like this, you would have the bulk of it off inside that first premium right here with that fair value gap. Does that make sense?
Yes, sir.
So this is a run from here to that high. So this level here at 40.22, just getting to this old high back here is 9.5 handles. It's not even taking out the buy side to get 9.5 handles. So if you had a limit order right above here for your first partial, like say you had 3 contracts long, you could take one off on a limit here, right at that high, right at the high. So you're going to give up the trophy of having an even 10 handles, but you don't care. That's not how you do it. Because you have to make sure the factor of the difference between the bid and the ask allows you to exit. And then you would take off the remaining 2 here. Where at the first low, which is this candle's high, you would put your limit order right at that level. As soon as it hits it, if it digs into that range, 1 tick above it, your limit order to sell would be a market order to sell at market. So then you'd have 2 contracts of the 3 you bought at the fair value gap down here. And then aim for either the midpoint or the upper end of the fair value gap less 1 tick. Because if it trades and prints the candle's low price here, which is the high of that shaded area, you want to be 1 tick below that to allow for the bid and ask spread to allow your limit order to get you off on that last third contract. You follow me?
Yes, sir.
And I think, my friends and neighbors, that's going to be it for today, because if I talk anymore, I won't be able to talk tomorrow. And we'll have another round of all this tomorrow because of the Fed chairman talking at 10 o'clock. I'll give you a real quick look at the dollar index. If you found today's live stream and commentary productive and informative, give me a thumbs up. What did I do there? Oh, I did it wrong. Did it as a futures contract. If you found today's live stream helpful and you were able to track this real time with us, and if it was informative to you, I appreciate a thumbs up. It's free to do it. Doesn't cost you anything. I promise no one knows you can do it or have done it. It's all private. It's just your way of letting me know that you appreciate what I'm doing here, because I don't have to be doing this. And I'm enjoying it. But I just want to make sure I'm getting feedback. And if you're on Twitter, if you'd like to follow me on Twitter, let me know how you fared today following along in this real-time commentary. Real quick, we'll just pass through the other indices. There's NASDAQ. So it's traded up into its city and its fair value gap that I didn't know, but it would be comparable. And then we have the Dow Jones, which is the weaker of them. No imbalances in here. See that? None of these candles in here have an imbalance. And then we traded, looked just like we just fell short of it, didn't it? The high at 364. High comes in at 363, so it never made its way up into the city here. So that is going to be it today. I appreciate you hanging out with us, and until I talk to you tomorrow, Lord willing, be safe.